Hello, everyone, and welcome back to the Traversing Entrepreneurship podcast, a show for business owners who set out to do something different and did not stop there. This is Dall'Olmo coming to you from Traverse City, Michigan, the city that inspired the name of this show. With over 18 years of experience in the finance industry, I've heard my fair share of successes as well as horror stories in business. On this podcast, I enjoy sitting down with a variety of entrepreneurs to talk about what it takes to build a successful business and all the things that come along with doing something different and paving your own way in life. In today's episode, I'll be interviewing Michael Shum. Mike is CEO of Cascade Debt, a fintech platform built to streamline diligence reporting for private credit and asset-based lending deals. Join us today as we discuss his insights and hard lessons learned on his path to building Cascade. Welcome to the show, Mike. Thanks for being here.
Yeah, thanks for having me, Derek. Glad to be here.
So can you give us a little bit of your background or your story? Myself, and our listeners a sense of how you got started and maybe what life was like before you started Cascade?
Yeah, sure. So Cascade is the third company
Okay.
I've really started. So after undergrad, I went the finance route. I joined the bank. I was a trader for 10 years, actually. I was a derivatives trader, trading commodities, currencies, fixed income. And my first day of work at the bank, Lehman Brothers went bankrupt. So it was a pretty wild time.
Pretty good timing.
Yeah, it was great timing. Actually, I mean, if you've got to learn, there's no better time to learn than during like a global financial crisis. So that was exciting. I was in Asia at the time. But while at the bank, I was looking for something that was a bit more fulfilling, is how I would call it, right? There's a lot of merits to working in a large corporation, and being in financial markets, was a passion of mine. But it also didn't feel like I was, doing anything that great for the world. And so while there, I had a side business. I started a recycling company. This was back in Hong Kong, actually, where recycling rates, for whatever reason, are extremely low. And having grown up in North America, you're used to, recycling glass and plastic and paper. In Hong Kong, like, that barely existed.
Everybody just throws everything away.
Yeah, you just throw it out. And so throwing out a glass bottle just feels wrong still, right? So
Yeah.
Started a recycling business with a friend, rolled that out and really got a taste of entrepreneurship there. Now that was like a side hustle, right? I mean, I was still working full time at the bank at the time. And just learning what it really meant to roll up your sleeves and, build something from scratch, right? I remember one of our first customers back then was a vegan restaurant who was taking a chance on us. But, as typical first customer, first time out, my driver, my collector both cancel on me. And so I remember in the middle of the day, I'm dressed, similar to this in business casual. I had to run out, call another van, and, I was slinging garbage bags in the back of this restaurant, basically dumpster diving in my business casual as I was, trying to get the collection finished up. Right. So, I mean, that was the start, but that business continued to grow, and it's still around today, actually. And we focused on hiring people from marginalized backgrounds. It's really interesting. Like, I just caught up with them about a while back, but, some of those first employees that we hired, it must be almost 8 years ago now, are still there. So that's continued on. But, after about 10 years at the bank, was looking for something new. And that's when a buddy I knew from undergrad reached out, and he worked at a fintech company doing alternative credit scoring. And he had taken a circuitous path as well. I mean, he went to undergrad in he did his master's in South Africa, and he joined a research project looking at how to close the gap for entrepreneurs in emerging economies, in developing countries where, there's no credit bureaus there, right? If you are an entrepreneur in Africa and you want a loan from the bank, good luck, right? And It's not that the banks don't have money to lend out. It's just they don't have enough information to decide whether you're a good borrower or not, right? And so that research project got privatized. It became an alternative credit scoring company, grew to, over $2 billion was lent against that score. They were in over 20 countries. And my friend was, almost employee number one there. And so roughly around 2016, 2017, we were starting to see these first wave of fintech lending companies in these developing markets, right? Just because a couple of years before, that's when companies like Lending Club and Prosper, like a lot of their kind of OG fintech lending and P2P companies in the US started to scale up. And so what happens is in the rest of the world, they see, hey, what's working in America? And they start, trying to emulate those business models in the rest of the world. And so we were starting to see these new fintech originators in these emerging markets, but their biggest bottleneck was on the capital side, right? And so we saw in them kind of a shared mission. They were also looking to, help financial inclusion, like make sure there was capital available, help the unbanked or the underbanked. And at the fintech that my buddy was at, so I actually joined him at the fintech, right, to try to pivot my career. And while there, we were seeing that these fintechs were tackling the same problem, but they needed money. And so perhaps naively, we spun out our own private credit firm. And so just looking at helping these fintech and non-bank lending companies and originators with their first debt facility, right? Give them the capital they needed to be able to on-lend to entrepreneurs or consumers in these markets that, had very little access to capital otherwise, right? So that company we started back in 2017, 2018. Back then, we were one of the first institutional investors in the debt space, working with fintechs and non-bank lenders. Like, this was completely new ground for most folks. And I mean, our fund was very small to start, like under $1 million AUM, right? So over the next 5 years, we scaled the business to hundreds of millions of AUM and just saw an explosion of growth in our industry, to the point where, at the beginning, we were just another, venture debt lending firm. We did corporate loans. But roughly around 2019, we discovered the world of asset-based lending, of private credit. And little did we know, but we were kind of at the beginning of an explosion of growth that has made private credit one of the fastest growing asset classes in the world today.
That's all you hear about from all sorts of people nowadays. It's private credit, private credit, private credit. Mm-hmm.
Yeah, like the super trend in asset allocation has been the move towards private markets away from public, right? And so private equity and VC have obviously grown tremendously over the past 10 to 15 years. The same reasons for why it has appealed so much to investors, lower volatility, greater access to more opportunities, they apply to private credit. And yet private credit is, by some measures, 3 to 4 times smaller than private equity. When you look at the public markets, you compare equity to credit, they're roughly the same size. If anything, the fixed income market is the largest asset class in the world, right? So there's a long way to go, and yet there's no reason that gap shouldn't close because of a lot of the tailwind markets in the markets. But even within the private credit space, asset-based lending or private asset-based finance has the highest risk-adjusted returns in the whole segment of credit, right? Both public and private. And so that's why it's growing so fast, right? People, you follow the money, right? Yeah. You can get, it's almost like a free lunch, right? Higher returns for lower risk. It's like, where's the catch? And so we flipped our fund to doing all asset-based lending back in 2019. And yes, it sounds good, right? And we did it because you got higher returns, you got less risk. I slept better at night. But the catch is these deals are super complicated to do, right? Your average venture debt deal takes 4 to 6 weeks to close, whereas your asset-based lending deal can take 12 to 18 months to close with the same company. And so we learned that the hard way. We had to learn how to structure these deals, how to manage all of these things. And just along the way, encountered a lot of challenges as a new fund. Number one being, how do we keep scaling AUM without hiring more and more people, right? And this was in an environment where not only were the underlying assets that we were financing getting more complicated because we were working with fintechs, the structures were getting more complicated. And then, of course, the volume of data we were dealing with was also increasing significantly Like long gone were the days where everything would fit on a spreadsheet, right? So that's why we started Cascade.
And so, you mentioned alternative credit scoring or alternative credit things. So is that getting to a lendability score in a different way, or is that just like instead of the credit bureaus that you think of, it's just another option to go get credit through?
Yeah, so I mean, back then it was there are no credit bureaus. So what could you use to identify whether someone would be a good borrower or not, right? And so their research actually settled on something called psychometrics, which was okay, even if you don't have a credit score and you don't have much financial data in general, right? Like you ask some of these entrepreneurs for financial statements, they don't have them, right? These are like informal businesses.
Sure.
But everyone had a personality type. And so they thought, okay, using, like they did a lot of research on using psychometrics to look at ways to identify risk levels based on, how they answered basically like a long questionnaire. And so the technology was really interesting and evolved from, I think, like a 3-4 hour test to eventually it was like a 20 to 30-minute test where after that it could accurately decipher whether a borrower would be, would repay or not. And it would measure things like willingness to pay, to layer into the ability to pay metrics that most credit bureaus are based on, right? So that you could come up with like a hybrid score that would give better signal on whether to lend to these entrepreneurs or not.
Huh. That's kind of wild, because everything credit bureau wise nowadays, at least what we know in the States,
Mm-hmm.
is like, how long have you had it? How long have you paid? How much
Exactly.
of it
You're
do
building
you
your
use?
credit history, all that
Right.
stuff. But what do you do in a place where that just doesn't exist, right? And so they combined that, and then eventually they also took in like mobile data and that type of stuff to do like, yeah, again, it's kind of like, you know, back then there was a lot more information on like social media as well. Like it was a bit more open as well. So it's kind of like, if people like, and part of this was combating fraud, right?
Okay.
In a lot of these areas. So it was just like, okay, if you put your address as X, I mean, it's pretty easy to figure out where it is just based on where's your phone at night every night, right? And so they could verify stuff like that.
On the Cascade side, you basically said, you wanted to streamline the process for,
Mm-hmm.
you know, getting to an asset-based lending agreement. How did you do that? I mean, I assume
Yes.
I assume there's a lot of data that needs to be gathered for
Mm-hmm.
that. You know, how do you take that mountain of data and streamline it and almost scrape it so that you or me is not doing the work?
Yeah, I mean, so the reason that most things, even today, are done manually is it's a super complex process. And like, you do one of these deals, and the loan contracts alone are like hundreds of pages with all sorts of different calculations that you need to do. And the problem is, even within the same investor in the same portfolio, every deal is going to be a little different, right? Not only is your underlying borrower different, like you might be financing small business loans one day, and the next day you're doing auto loans, or you're doing an earned wage advance or a revenue based financing deal. But everything is basically customized to that
Okay.
deal, right? I think one of the double edged swords of private credit is you can structure anything, right? And so that just means that they will structure anything, right? And there's a wide universe of different things, like from covenants to how you calculate things, that there's a lot of nuance to it, which means like if you need to build a system, you can't just be like, oh, it's not like I buy a bond or I buy a stock and it's the same every time. Like in this case, it's like I've got this set of covenants, I got these set of calculations, and the underlying cash flows are completely different. You work with 24 borrowers or portfolio companies, they're sending you data formats in 24 ways, right? And so that's at scale, that's the problem. And so how traditionally a lot of these investors have dealt with that is like, look, I'm only going to do deals that are worth my time, right? Because it's basically the same amount of work to do a $5 million deal as it is to do a $500 million deal. So depending on the size of my fund, I'd rather do the $500 million deal,
Of
right? And
course.
if it's going to take 12 months to get this deal closed, that's what makes sense, right? And the reason why it takes so long is because the reason we've talked about. So the way we do things and how we solved that was we broke things down and we take a first principles approach to monitoring and building everything. Like at its core of all these things is the data related to these deals, right? And so our first principles approach means we're dealing with raw data inputs. So this is like, instead of just taking a summarized version of this is how every loan is doing, or, this is how many days past due this is, we're looking at the individual payments and cash flows made to each individual loan. And we use that raw data as the building blocks so that we can calculate anything, right? So that if they need to calculate delinquency one way or amend the calculation a different way, we still have the raw data so that we can tweak our calculations. And so that's where we start. We take a heavy focus on data. And like you think about during that 12-month process, a lot of time is spent just cleaning data, getting it standardized, all of that stuff, so that, just like all the work to make a decision, to be able to start your work, right? And that's what we take off the table, right? I often ask a lot of our customers, like, how much would it be worth to you to never have to deal with data issues again? You don't have to chase people for it. You don't have to clean it. You get a new file. It's like, oh, shoot, the columns have changed or the date formats are wrong, things like that. We solve all that for them so that they can, by the time it gets to them, they're doing, the high value add stuff. They're making good decisions. The other thing that we do is, like, you're going from a market where the standard is, periodic, call it monthly or quarterly, self-attested spreadsheet-based reporting, to one where we're providing real-time, verified by a third party, like in a purpose-built system reporting, right? Like imagine doing stocks and keeping track of everything on your own spreadsheet once a month and going instead to, real-time data on a Bloomberg or on, Google Finance or something like that, right? That's kind of the evolution that we're allowing in our space. And we do that all by going into the details on the data side, and on the contract side, we build everything bespoke, but we also have templates internally and standardized schemas internally to be able to handle the wide variety of different things we can look at.
So how is, I guess, the private credit side different than, you mentioned, like private equity or, VC funding, all the other, call it private markets that were, in the hype cycle, 2020, 2021 type of thing.
Mm-hmm. Yeah, I think equity and credit are very different, right? I think one way to frame it is, on the equity side, it's about your winners, right? VCs love to talk about their unicorns, or, I invested in that company when it was worth just $1 million, right? On the credit side, it's the opposite, right? It's not about your winners, it's about your losers, right? The war stories are not about like, oh, that deal that I, collected my full coupon, it winded down and was successful. No, the war stories are about, man, we got into a workout situation, we almost lost all of our money, but we did this and we managed to recover everything. And so that mindset of, in credit, it's about your losers and how much you lost on them, means that there's a lot more focus on the risk, right?
Okay.
Just because on credit, you have capped upside and unlimited downside, which means you focus, and whereas on equities, it's capped downside, unlimited upside. And so investors are always going to focus on where the unlimited side is, right?
Sure.
And so on the credit side, it's about, okay, how do I reduce my risk? How do I make sure I don't, they always say in our business, it's easy to give money out. It's much harder trying to get it back.
Much harder to collect.
So all the focus is on, how do I get my money back, right? And so that's one fundamental difference. And that's why there's so much more structuring in these things, right? Like you do a VC deal and like things are pretty, like, yes, equity, every company is different, right? It's about telling a story and all that. But when you do the financing, especially in the early stages, you can do a safe, right? Like seed rounds are pretty standardized at this point. In our business, it's still very, very varied. Every investor's got their own ways of mitigating risk and how they structure these deals. And that's why it takes so long. The other main difference between the two are I think just like the universe of companies, so that are like potential investees in this market. So private equity VC, when you think about it, it's actually not every company can be VC backed, right? Like they say,
No.
if you're not going to be a unicorn or a billion-dollar company eventually, you shouldn't even go down the VC backed route. And same for private equity, right? Like they're coming in when you're probably at, 25 million plus in recurring revenue. And like, so when you think about it, it's a small universe of companies that are applicable to private equity and VC, right? You're almost talking like the best of the best.
Sure.
On the private credit side, there are hundreds of thousands of companies who are not good for equity investment, but could use credit, could use debt, right? Anything from a very simple bank loan to, much larger, more sophisticated like securitizations, right? And the reason being like you're underwriting balance sheets or you're underwriting the underlying cash flows, right? That's the big insight in asset-based finances. Hey, we can kind of separate the company from the receivables and the cash flows that they're generating, right? So one lending company who might only have $5 million in their balance sheet might have a portfolio of $20 million of receivables that generate cash flows, and you can actually underwrite or understand the risk of those cash flows a lot better. And if that's your collateral, you get way more comfortable doing much larger deals, which is why this market has been growing so much. So
kind of wild. That's what basically, me on the, finance and tax side have been asking banks to do for ever. And, they're just now starting to look at, underwriting cash flows. And you're like, look, there's, recurring revenue of $5 million. Why can't you loan this company $1 million? Well, we don't have a building or a car or, or what.
Yeah, exactly.
Like
they're looking for physical collateral. They're looking for cash in the bank, and they're discounting your recurring cash flows to zero, basically.
Yeah. It's like, isn't like, it's like you and I, when I look at a company, I look at how much cash flow they have versus what their expenditures are, right? So it's like, okay, how much is in, how much is out, how much is retained? And like, that's the value of the business, not, do they have a, mirrored glass headquarters that they can, put a sign on.
Yeah, I mean the industry has evolved considerably. It used to be lending companies was consumer loans, small business loans, auto loans, credit cards, like very typical stuff, and like those still make up the bulk of the market.
Right.
But these days, especially with fintechs, now you have like earned wage advance instead of payroll, right? You have revenue based financing compared to what you had where they would have had to take something out against collateral, right? You have even the esoteric stuff today, you have like royalty streams, you have like electricity like contracts. There's a lot of asset-based lending going into like data centers today, right? And so what the world is slowly or very quickly waking up to the fact is the world runs on contractual cash flows. And as long as you have a stream of contractual cash flows, you can lend against those directly rather than against the company generating those cash flows or originating those cash flows.
So, you kind of went all in on this in late 2018, early 2019, which, then some big changes happened in 2020.
Yeah.
How did that alter what you were doing, or did it alter it, or did it, shoot you to the moon or tamp you down? What was that period in time like where kind of things ground to a halt?
Yeah, I mean, during the pandemic, it kind of highlighted the need for more visibility on these things, right? Especially a lot of lending companies in some countries, you were legally not allowed to collect, right, on your loans, right? In the US, like student loans being a very good example of that, right? So if you were a student loan originator, what are you going to do? Like the government has said, okay, no one has to pay during this time. And so you're kind of just stuck. But in like other industries, what we were seeing is, again, like it was no longer good enough to wait until the end of the month or the end of the quarter to be able to see like, how's this portfolio doing? And how are these cash flows still happening? right? And so that really underscored the need for a purpose-built system to monitor the risks involved in a portfolio and to just have a better view of it. But that aside, I mean, we saw it in the equity markets as well, but the markets recovered very rapidly from
Oh
there
yeah.
to the point where today, I mean, look, private credit's growing as fast as it ever has, right? And if anything, there's a lot more money out there, especially as a lot of the money is coming from insurance companies these days, who are looking for yield, and so yeah, it's actually favoring the borrowers quite a bit these days in the U.S.
That's kind of nuts. Yeah, everybody's looking for yield, but they also want to get. So I guess let's put it this way. You know, pre and during COVID, you're getting loans for, you know, 3, 4, 5%. Now they're 7, 8, 9%.
Mm-hmm.
Where does private credit live in that world? I mean, are they,
Yeah.
12, 15, 20, or, or are they
Yeah,
in
so
the,
generally in like these asset-based lending deals, most US investors are looking for like double-digit returns, right? Low to mid-teens is generally where it's going to be at. It's going to be struck against SOFR, so it is floating
okay.
in most cases. But that's generally where it is today. And like globally, that's where it is, right? You're looking at double-digit returns in this space, which is, you compare it to even like investment grade bonds and things like that, we're talking multiples in terms of that
Yes.
yield. Now, is it as safe? I mean, so far it has been actually. Like like for the same volatility level, they've way outperformed a lot of like the public credit and debt instruments out there, which is why you're seeing so much money entering the market, why you're seeing insurance companies who are traditionally, I mean, they have a lot of float, they have to manage a lot of money, but traditionally they buy treasuries, right?
Yeah.
But if anything, these days they're starting to expand to the private side because for the exact same reason that, a lot of investors put money into private equity, like especially endowment funds, longer time horizons. It just makes a lot of economic sense to allocate there. And so it's a secular trend that even in, kind of the volatility of today, right? With tariffs and all that stuff, it still represents one of the best places to put your money. So,
Yep. I've always believed that the private markets were the best place to put money. It's just never really had access to all of them. As a, you know,
as a retail
I'm
investor,
on the institutional side, but I'm a retail investor when
yeah,
it comes down to it. Um,
yeah, absolutely,
it's like, the only people that had access to that are, the Goldmans, the HSBC, the big banks of the world who
hmm
are basically,
it's
you
becoming
know,
more accessible for sure. And I
yeah,
mean, that's why, like at Cascade, we've grown so quickly. Just it helps when your market is growing, right?
yeah.
And the pie is getting bigger for everyone. And so we've grown fairly quickly. We work with over 80 originators now, almost 24 institutional investors today. And like it's just back to our original mission of like, how do we make capital more accessible, right, for borrowers? And a big part of that is providing the infrastructure for investors as well. To, our ultimate goal is taking these deal processes that take 12 months with limited visibility. If we can, keep cutting down that time to where doing a private credit deal is just as easy as doing a venture debt deal, we've done our job and it helps the industry grow even more.
So, you mentioned earlier, how do you scale without adding more and more people along the
Mm-hmm.
way? How have you been able to do that?
Yeah. So, I mean, we help a lot of these companies who are spending either engineering time, right? They've got their own tech teams or their analyst time to use our software to save time, right? A lot of the manual grunt work on the data processing and cleaning, on generating graphs, on chasing people for data or reporting. We can generate a report that would have taken an analyst, days, if not a full week to do. We can generate that in seconds now, right?
Okay.
And taking it, and much more accurately as well, right? So in that way, if before an analyst could have done a couple deals a year, if we're having the time, that means they can double their throughput. So not only are they, the same firm can potentially make every team member more productive. You're doing more deals, so you're saving both cost and making more revenue with our software.
I mean, it sounds spectacular, right? I get to lower
That's
my
why we've been
cost
growing
and
so
raise my
fast.
revenue.
But yeah.
So, everybody kind of looks at success differently, but like for you and Cascade, what let's talk about wins for a second. What would you say your biggest, wins or successes have been since starting this, I guess since going
Yeah,
all
I
in
mean,
on
look,
this?
we're venture backed, right? And so the goal from day one has, how do we turn this into $1 billion company?
Okay.
Now, fortunately, we work in a market and asset class that is measured in the trillions, right? So it's certainly like the TAM is big enough for us to play. In terms of the wins, I mean, we've gone from 0 to 1 here, right? It's just in the early days, it wasn't so certain, right? Like when I left to do fundraising, I remember it was, the Ukrainian war just started. There was a lot of uncertainty. Things were, everyone back then was just talking about like, oh, the fundraising hype of 2021 and early 2022 is over. Instead of like growth, you should be saving money. And so like, everyone was buttoning down their hatches. But to go from there, like, we did a round, we continued to scale, and now we have a team of, 20 people and are growing. Like, it is quite satisfying to see, build something from scratch, from 0 to 1, and know that it's still just the beginning, right? There's still so much we can do. We're just scratching the surface of the impact we can make. So,
it's kind of weird, in just in this 30 minutes we've talked about a pandemic, we've talked about a war, we've talked about tariffs, have all been mentioned. And, it kind of brings up the theme, that I tell people, like the more things change, everybody says this time is different, right? And it's like, the more you look at it, the more it's not. It's like, it's all happened before in some way, shape, or form. It's going to, whatever happens is going to happen, but it's going to come out on the other side. It's not going to just stop things dead in their tracks and be done with it forever. It's just kind of like, okay, yeah, that's
just gotta expect the unexpected, I guess, right? Like,
and be comfortable being uncomfortable. Be comfortable with the uncomfortable. It's like that's the world we live in. And
you gotta be nimble. Things change all the time, right? I mean, you just look at the proliferation of AI today, right? Even compared to 2-3 years ago, it's completely different.
Even to a year ago now, I mean, before we started recording, I said I use Otter, to record meetings, and it was, it was great to have a transcription, that was put together for me. And
I mean, we're leaning heavily
into
that, not only as, building product to use AI more, but like even internally, I mean, something that we do now is we give everyone on the team like a AI productivity budget where it's just like, hey, find the best tools, right? If you're not using AI today, you need to be. And so we give everyone a budget to just go and try new tools. And we do, I mean, it's pretty amazing some of the things that they've been able to figure out and do. And, it's just amazing kind of also like the speed of execution now with AI means that, you're going to get left behind.
Right.
Unless you lean in to this stuff.
It's pretty spectacular what, computers can do in, nanoseconds or whatever
it's
the time
crazy
is.
How far we've come. I mean, I was like, I did a master's in data science. This is back in 2018 at Berkeley. And I remember back then, like we were reading, like I took like a natural language processing course. We were learning about transformers. So like a lot of the stuff that preceded like these LLMs and ChatGPT and all that stuff. And even back then we were already marveling at like, oh, wow, this is like, the translations have gotten so much better, but like, certainly didn't foresee everything that's happened since. Otherwise, I should have started one of those companies.
I wish I, came up with the code that can do that, because
exactly.
It's just wild.
No, but it really is an amazing change. And I mean, I guess like, as an entrepreneur, that's, it's exciting to play here. Like kind of at the forefront of so many different trends. But if you don't keep up, you're going to get left behind very quickly.
Yeah. So, on the flip side, what are your biggest, I guess, headwinds, not only for the company, but for the asset class, what do you see as like, hey, yes, it's expanding right now. It's very
Hmm.
in vogue. Everybody likes it. Where is the potential for contraction, or where is the potential for the bad times in private credit?
Yeah, I mean, like I think from a more macro point of view, it looks like, I mean, look, things are a lot more uncertain today than they were even a month ago, right? I was just reading stuff on, the potential for a recession in the US is much higher today than it was a month ago. And although I don't think we're directly impacted, but recessions are not good for anybody. I mean, in fact, like we have a global business. We work with some companies in Asia, and they have exposure to Chinese suppliers, right? And
Sure.
so I was just in Asia last week talking to them, and they were mentioning that yeah, I mean, our Chinese volumes are down significantly, right? Just because they're not exporting as much, they don't have to do as much supplier finance. But on the flip side, India has picked up considerably, right? And it's just, with all this economic uncertainty, it's not good for, business in general. And so I would say that is definitely a headwind, right? And the other aspect for us is just, as a SaaS company, as a tech company, we always have to be cognizant of the fact that, like, we don't want to be obsolete. As young as we are, AI is making a lot of things obsolete. And so, how do we stay ahead of the curve? How do we make sure that we're still adding value and we're, delighting our users in a world where the bar for being impressed keeps going higher and higher based on,
At
how
an
much the stuff we
exponential
do.
rate.
Yeah. So
It's like you
that's
start to
the
see that with
other,
like Nvidia now. It's like, they're still crushing things out of the water, but people are expecting them to
yeah.
blow it out of the water by even more than they
Yeah.
did.
Yeah.
So now
For
it's a
sure.
disappointment. You're like, wait a minute. When did exceeding expectations become a bad thing?
Yeah. Like it never gets easier, right? Like the
No.
expectations only go up. So I think that's, and like we're still early in our journey, right? But just figuring out how to keep scaling is, top of mind for us, and how
Yeah.
to build a best in class product, like continue building that. So those are two things that are top of mind for us right now.
When you look back at the last, 5, 6, 7 years, of scaling this to where it's at now, what's been the hardest thing to, control or manage?
I think, like, in terms of building the business, the hardest thing I think has been just, I think, like every company, like you go through different problems at different times, right? At certain times, it's like, oh, I need to do fundraising, I'm out of money, or like I don't have any money, right? Like when I did my first fundraising round, and like fundraising is still some of the most intense, one of the most intense processes you can go through, right? I was doing like, you know, 14, 15 calls a day with investors trying to get everything across the line. In terms of like scaling the business, I think it really is not just getting customers through the door, but making sure that you continue to deliver value, and that they understand how to use your product. Because sometimes you take it for granted, right? Like you see it every
Sure.
day, you use it every day, and things that you build are not so obvious to external users. And so, like, how can we make this better? How can we also, deliver on things that they need? So those are the main things that we grapple with today.
So it's it's interesting to see kind of the shift in perception, from the outsiders like me, right? It's like, yeah, we've seen, kind of all these things come along. Like I've been in, the finance business since 2006.
Mm-hmm.
So it's like, back in '08 or no '09, it was kind of the hedging things, long short funds or,
Mm-hmm.
whatever. Then it went into kind of private equity and then VC and now private credit. Um, it's been interesting to see kind of how the perception changes, across the board. It's like
Mm-hmm.
everybody's cautious at first and then they see,
And then
you
they
know,
pile in, yeah.
and then they pile in. And I think, I'm looking at a piling in phase of private credit, or at least probably the early stages of piling in on private credit. Apparently I'm talking like a duck. Quit it. Sorry. But, I don't, like, even with private equity and VC, like, there's not really a cap on what it can handle, right? Like, when you get to a derivatives based thing, like a long short fund or something, there's a cap on how much you can do there. But it seems like with the private equity side or private credit side, there's not really a cap because, in theory, the entire market could shift to that as opposed to being a public piece.
Yeah, I think if you compare public to private, right? Like the public equity and debt markets are worth on roughly, call it 60 trillion each, right? Private equity VC is worth, call it 10 to 15 trillion. And then private credit and plus asset-based finance, call it like 2 to 5 trillion, right? And so it's a huge gap still between the public and private markets. And I think a big part of that gap is just infrastructure in a lot of cases, right? Okay. Like you think about in the olden days of stocks, like, people were literally looking at paper tickers or, like information wasn't really available and there was a lot of scams and like stuff like that. It was literally the wild, wild west back then, right? And how far we've come in that. And I think, private equity VC, it's been 10, 15 years, right? But in the grand scheme of things, that isn't that long, right? We're still in the early innings of that. And if you look at private credit, we're in the first inning of this, right? Yeah. So there's a long way to go. And part of what makes me so excited about building Cascade is if we accomplish our mission and we provide that infrastructure, it's almost like a self-fulfilling thing where because companies like ours exist, private credit can keep growing, and it, obviously is a tailwind for our company, right? So, yeah, there's a long way to go, but you're absolutely right. The sky's the limit for our industry.
It really is, especially as perception changes. It's being more widely accepted. I'm having conversations about it. The first step for me is having conversations with the people who are representing these funds. But it's like up until probably last year, I wasn't even willing to have that conversation. So it's like, okay, there's an acceptance on my end, which now goes towards, okay, now there's going to be an acceptance at least partially in the end investor space. That's all I see for that is kind of gates opening here pretty soon. Because if I look at flows, I would argue that the flows to private credit and the other private spaces is it may not be as large, but I'm thinking from a overall makeup space of, hey, here's how big, like you said, 2 to 5 trillion. You're probably getting flows into that space that are much larger percentage wise as opposed to the flows in the public space just because of the size difference. So
yeah, you're seeing it in like how endowment funds will publish their allocation targets, for example, right? And all the largest endowment funds in the US have basically, it used to be private markets was an allocation. Now it's split between private equity, private credit for the first time, and private credit's getting its own bucket, right? And that's just as the industry matures a bit more, there was a long education process, but now it's seen as like, oh, okay, yeah, private credit is its own thing. We need to be allocated to that. And that's the beginning. That's how private equity started back in the day as well. So there's a long way to go for sure. And if you look at it, I always call private credit or asset-based finance one of the most niche, completely unheard of $1 trillion markets out there.
Yeah.
Right. So there's not many. Like I always used to contrast it to the crypto market, right? Much more high profile. If you look at the size of the crypto market, it's like 2 to 3 trillion, depending on where things are. It's quite volatile, right? So you're talking about a market roughly about the same size, if not smaller, than private credit and especially asset-based finance. And yet it's so much more high profile And there's so many people building infrastructure and tooling for that. Whereas in our space, it's, relatively sleepy. It's unheard of because, again, it's much more institutional focused. But man, the capital in our market is growing significantly. So,
yeah, and I mean, I have to imagine that's part of that is, like you said. I mean, it's institutional based for the most part. It's not a retail focused piece like crypto. It's like, oh, hey, look at this. You can do it on your phone.
The crypto markets are much better in marketing than the private credit markets.
Oh yeah, well, we'll see. That's probably a good thing. Just the people that you see, buying and selling crypto now are probably the people that should be the last person doing it.
Yeah, it's less investing and more gambling.
It's very much the same. You're just like, wow, you might as well. If you want that rush, it's like, go to the roulette table,
exactly.
go, black or red, it's so how can listeners find out more about Cascade Debt? Where do they go to find it?
Our website's cascadedebt.com. You can find me on LinkedIn as well. And always happy to have a chat with, others in the field, or, potential investors in this field.
Okay. So we usually end every episode by, giving the guests a few minutes to leave a message to listeners, whether it's advice you have to give about aspiring entrepreneurs or, promoting Cascade, whatever comes to mind, something you care about, whatever it is. It's time for you to give our listeners a little bit extra of what Mike has to
in
offer.
Terms of advice, I would just say, it's not easy, right? I remember being at the bank on the corporate side and just dreaming of building my own thing, and like the grass was greener, and you're reading books like 0 to 1 and stuff like that. It's not easy, but man, is it fulfilling. And working through the challenges, building things from scratch is worth the sweat, blood, and tears that goes into it, I must say.
And money.
If you feel like that's what you want to do, like I'd say go for it. You won't be bored is what I'll say.
You're never bored. Make sure you get some anxiety medication because that, people have to, it's
sometimes
crazy.
You'll wonder why you did it, but when you're looking back, it's still, it's an amazing journey.
Good. Well, as you know, my name is Dall'Olmo. I'm the owner of both Tremonti Financial Consultants and Tremonti Tax Solutions, together referred to as Tremonti. Tremonti bridges the gap between financial advisors and accountants by serving as CFO to our clients. We specifically love to work with business owners to develop a proactive tax strategy that maximizes after-tax profits. It's our job to help you earn more, be more efficient, and pay as little in taxes as legally possible. If this idea piques your interest, please go to TremontiTax.com and hit the schedule now button to book a 15-minute chat with me. Whether we end up working together or not, I'd love to hear from you. For those listening, if you enjoyed today's episode and had a few helpful takeaways, we would love for you to leave us a review on Apple Podcasts and share this episode with other business-minded friends. This has been another episode of the Traversing Entrepreneurship podcast. We had fun today and hope you did too. Thanks again, Mike, for being here, and thank you for tuning in and listening.
Thank you.
This podcast is presented by Tremonti Financial Consultants, LLC. The firm is registered as an investment advisor and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor does not constitute an endorsement of the firm by securities regulators, nor does it indicate that the advisor has attained a particular level of skill or ability. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. You should consult with a professional advisor before implementing any of the strategies discussed. Content should not be viewed as an offer to buy or sell any of the securities mentioned or as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment or strategy will be suitable or profitable for an investor's portfolio. There are no assurances that a portfolio will match or exceed any particular benchmark. All investment strategies can result in profit or loss.